let's see what is the concept of the cheapest to deliver. This is a very small concept in ICI module, not very well elaborated, I think. So in order to, delve further into the concept, I have made this short video. So starting off with the first principles. एक बैंक है. Let's just say you have a bank. A bank holds portfolio of bonds. Okay, the bank holds a portfolio of bonds, or it has a short portfolio of the bonds. That is, it has a short position on the bonds. What do you mean by that? You have a loan on the bonds, like you have issued these bonds, whatever would be the case. Okay, let's just say the bank has a portfolio of bonds, so you have a long position on the bonds. So in order to hedge yourself from the movement of interest rates, what you need to do is to sell the futures. Okay, and why do you need to sell the futures? The basic aspect of hedging is, to hedge means to take opposite bets. So if you have a portfolio of bonds, what you want to do in order to hedge is to sell the interest rate future. So the bank has sold the interest rate future, or in market terminology, it has gone short. What happens in the settlement? The bank would have to close out the position by either going long on the bond, on the contract of future, or delivering the bonds themselves. Okay, so either the bank has to go long, that is to go in the market and buy the future contracts again, which they have already shorted, or they have to deliver the bond. So the price at which the bond would be delivered is called the settlement price. Okay, this can be equated to what we usually call the excise price, and in our case we have assumed that the excise price is 1,000 rupees. So just to give some background, what is a conversion factor? The conversion factor is just another number. It is a metric which helps the banks or regulators or even investors or whatever to compare bonds of different maturities, of different coupon rates, of different yield conventions, day conventions, accrued interest, etc. So it is something called, it is similar to relative valuation. That's why I equate it to relative valuation metric for the bond. So it has a conversion factor which is based on the settlement price. So this would be based on various factors on which a bond can be evaluated. And in order to help you or the bank to settle this contract, a conversion factor is calculated. Okay. Now, let's see if the bank has the following portfolio. The bank has four bonds, A, B, C, D. They have the current quoted price, that is the spot price, as follows. The settlement price for each of the bond would be 1,000 as stated. This is the excise price. The excise price times the conversion factor, that is, you are scaling the excise price to its relative valuation, and therefore you get the SP times CF, that is your the amount at which you will settle the contract. And you would want to settle this contract for the cheapest. At what would be the cheapest? The cheapest would be in which you make a profit. And how do you make a profit? So let's look at SP times CF is the amount at which you settle or sell the bond, and currently you are holding the bond at S0, that is your spot price. So the gain or loss would be calculated as follows. So SP times SP times CF is 1037 minus the quoted price is 1037.4. So you get a loss, you get a loss again, you get this loss here, and you get a profit here. So it would be beneficial for you to deliver bond C, which has a current quoted price of 8.877, while it has a relative valuation which is higher, and therefore you make a profit, and that is the cheapest to deliver concept. So in order to settle this contract, bank the bank should deliver bond C. And I think that is all for this concept. This is me signing off.